Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
What the world needs now is people who see flight a little bit differently. Because seeing a better connected world isn't far in the future. We're building it now. GE, building a world that works.
The fight to clinch the media rights of Indian Premier League or IPL for the next 5 years was no less intense than the matches itself. And the money put on the auction table made the IPL world's number 2 sports league, with only America's National Football League ahead of it in terms of per match value. So why has the race to grab the TV and digital media rights become so intense despite a dip in IPL viewership? And what do the winners stand to gain? Let us find out in today's segment.
It had all the ingredients of a racy cricket match, something which we usually see during IPL seasons. And a lot was at stake. Global tech majors, Amazon, Alphabet and Apple Inc. were among the giants vying for the media rights to broadcast IPL matches for the next 5 years. But on Friday, the 3 US giants dropped out of the race, leaving 7 competitors in the fray. And of them, Viacom18, Disney Star, Sony and Zee were involved in the bidding war for the Indian Premier League's 2023-27 cycle. IPL's 2023-27 cycle will have 2 separate broadcasters for digital and television. In Monday morning's session, the IPL TV and digital rights auction had closed at a total value of 43,255 crore rupees, which translated to 105.5 crore rupees per match. That value subsequently increased to 44,075 crore rupees. Meanwhile, the revised per match value stood at 107.5 crore rupees. A Business Standard report, while citing sources, said that there was an incremental bid of 50 lakh rupees placed in the television category, thus taking the per match value for TV to 57.5 crore rupees from 57 crore rupees, which was the figure at the close of bidding on Sunday. The total value of IPL TV rights now stands at 23,575 crore rupees for 410 matches. Meanwhile, the digital rights have also increased to 50 crore rupees per match, or 20,500 crore rupees overall, from 48 crore rupees per match or 19,680 crore rupees earlier. And the winners were Viacom18 and Disney Star. While Viacom18 bagged the digital rights for IPL, Disney Star got the television rights. These numbers have propelled IPL to the spot of the number 2 sports league in the world. The per match value of the IPL has touched 107.5 crore rupees. This is second only to America's National Football League, which costs a broadcaster 132.26 crore rupees per match. The English Premier League costs 85.58 crore rupees per match. Let's put the growth in valuation in perspective. Disney Star had bagged the combined digital and TV rights for the IPL in 2017 for 16,347.50 crore rupees. Back then, the per match value stood at 54.5 crore rupees. These numbers will also come as a big relief for the IPL and BCCI. In recent weeks, a sharp fall in IPL's TV viewership had led some to question the base price set for the media rights. Sony Pictures Networks India's MD and CEO NP Singh had told a Financial Daily that the reserve price needed a reality check amid this decline in viewership. Compared to last year's figures, IPL's viewership fell by 30 to 35% in the first 4 weeks of the 2022 season. In fact, With viewership falling consistently, reports said that some advertisers had even asked Disney Star to make good their losses by offering them spots on alternate high-impact properties. So, what explains the premium that IPL still commands? Also, what will be the impact of TV and digital rights going to different players?
So digital premiums are about 70% versus the base price, which is obviously in line with the expectations because obviously digital is something which is growing at a very fast pace. The digital media industry is growing at 30% plus in terms of growth rates. As far as TV is concerned, the premiums there are close to 25-30% higher versus the base price. Now, this is despite this decline in terms of IPL viewership by BARC, which is there. Because I clearly believe that these are not trends which are sustainable. I think this is just more of potential unlock wherein people would have moved outdoors and may not have consumed that much amount of TV, in the last couple of months in the last season. So I think the unbundling aspect of it will have a negative impact because a lot of the large deals, which are the deals throughout the matches, for all the matches, are on a bundle basis. You have some spot deals for the playoffs and for the finals and for the key matches, in the tournament, wherein you have a lot of spot basis deals as well. But close to 70% of the deals are basically bulk deals, which are throughout the match. So it is going to be a challenge to actually beat the numbers that Star would do for any of the new player who comes in. But if they are able to crack the code, I mean, they can even do better as compared to what a Star is doing. So
another question revolves around the winners recouping their investments.
Whoever's bought the TV rights, I think there is not too much to do basically because TV is more of a mature medium and it's growing at about 6 to 8% kind of a CAGR basically as we speak from here on. And in terms of the revenue as well, what TV generates today, I think Star is generating somewhere close to 3,500-4,000 crores in terms of the TV rights. And if the numbers are to be true of this 24,000 crores in terms of media rights as per the reports, we are talking of a content cost of 5,000 crores. So I think largely, it is only 1,000 crore loss which is there, which will probably go away in the next 2 years. And we are expecting that by third year onwards, you will see a break even as far as TV medium is concerned. But because the growth rates are very tapered on TV, 6 to 8%, there is not much of innovation that one can offer. And because of tapered growth rates, even the profitability aspect, the TV media, whoever has bought the rights, I think the gross profit margin on that will not be more than 10 to 12% in a best case situation in the last year itself. So I think that is how the TV media will be there in terms of the profitability or the return aspect of it. As far as digital is concerned, there's a lot of opportunity there. The digital media segment alone is growing at 30% in India. And given IPL, the kind of property it is, it can probably grow at 40% plus. And both segments within digital, whether you call it AVOD, SVOD, both are growing at a good pace of 30-35%. But I think a lot of work has to be done there in terms of innovation, interactivity, in terms of what we are expecting because of Web 3.0, in terms of dubbing, in terms of user experience of a platform, because digital is all about customer retention. If you compare this to a TV basically you already have a customer base which you're serving. So there's not much more we can offer. But I think digital is a rat race. It's a very tough fight. There are too many platforms, too many things happening on tech and user experience front. So a lot of work has to be done on digital if you were to achieve that 40% kind of growth rate. And if one were to do that, we are estimating that the break even again for digital as well will happen in third year. But I think in terms of the gross profit margin for the digital media segment, I think there's a potential of 35-40% in the fifth year. So digital that way offers a delta, better profitability scenario as compared to TV. But that depends in terms of the strategy and the execution which has to be done.
The BCCI and IPL franchisees are the biggest gainers from the auction. The money involved in the auction has also made a few things clear. IPL is still a hot property for both media houses and advertisers. It is still a one-of-a-kind asset that helps broadcasters gain an additional user base and gives advertisers sway over hundreds of millions of viewers. But there is one concern that needs to be addressed. In May, it was reported that the CBI had started a countrywide probe into the alleged fixing of IPL matches. There is even a Pakistan angle to it. Were the IPL's credibility to be damaged, it would be a huge step back after Indian cricket's giant leap on Monday.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4,000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4,000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है इन्वेस्टिंग मेड easy and rewarding with 5 पैसा. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
But not all business models are as lucrative as IPL. Scores of companies are floated every year and some return to the pavilion without playing a long innings. Ravi Mittal, chairperson of the Insolvency and Bankruptcy Board of India or IBBI, recently said that there should not be any stigma attached to genuine business failure and companies should be given honorable exit. The Insolvency and Bankruptcy Code 2016 was introduced in May 2016 to tackle bad loan problems, but it has been plagued with high haircuts for banks and delays in the resolution process. So what can be done to achieve quicker resolution? Let us find out.
Before Insolvency and Bankruptcy Code 2016, the insolvency and bankruptcy laws in India were multi-layered and fragmented. IBC created umbrella legislation for insolvency resolution of all entities in India, both corporate and individuals. IBC's journey so far has been a mixed bag. In the last 2 years, the debt resolution of SIC companies slowed down considerably after initial euphoria saw several successful acquisitions by top companies, including the Tatas, Reliance, and the world's largest steelmaker, ArcelorMittal. The problems include a very high haircut, as much as 95% in some cases for banks, and delays in the resolution process. The provisions of the code that came into effect in December 2016 aim to serve two purposes: to save businesses that are viable and facilitate the exit of those that are not. Since then, as many as 5,258 insolvency cases have been filed by lenders. Of these, 3,403 cases have been closed until March this year. Of the 3,406 resolved cases, nearly 47% of companies were liquidated and 17% were withdrawn after 90% of lenders agreed following an offer made by the promoter. Around 22% of the cases are still ongoing, while in 14% of the cases the resolution plan has been approved. Apart from overburdened courts, a serious problem faced by lenders was that asset reconstruction companies are not allowed by the RBI to bid for bankrupt companies. Legal experts say that frivolous challenges and interference by erstwhile promoters, directly or indirectly, to delay the resolution process must not be entertained. The IBC prescribes a time limit of 180 days for resolution, extendable by another 90 days. However, an outer limit of 330 days has also been prescribed for the completion of the resolution process, including the time taken for litigation. The 480 cases which yielded resolution plans took on average 450 days for the conclusion of the process. And of the ongoing cases, 66% have been pending for more than 270 days. But the IBC's track record has been better than the earlier laws. The realizable value of the assets available with the 480 companies rescued was only 1.31 trillion rupees, though they owed 7.61 trillion rupees to the creditors. The resolution plans realized 2.34 trillion rupees, which is around 178% of the liquidation value of the corporate debtors. Financial creditors recovered 32.89% of their claims, which only reflects the extent of value erosion by the time the companies entered the insolvency process. Yet it is the highest among all options available to creditors for recovery.
Although the code was enacted with the primary aim to deal with corporate insolvency instances timely, but in practical sense, none of this is being practiced. To state an instance, the insolvency proceedings of JP Infrastructure took 5 years to conclude as opposed to the period of 330 days. So there are no regulations to govern the non-performance of the officials appointed under the provisions of the CIRP. And more often so it happens that these officials are replaced with the new ones and the entire process stands still till such appointment. It is true that IBC requires some alterations, but what is even more necessary is some objectivity while dealing with the creditor claims. So clearly the limitation period stipulated has been blatantly ignored, but there are some other factors like time and the quantum of claims and the receipt of sound resolution plans that necessitate moratoriums by the tribunal. So lastly, even if the case reaches a decision, recovery of the financial debt is a major grey area left out of the scope of IBC. So the principal debtor, the creditors as well as the tribunals are all affected by these issues due to the paucity of time and resources invested, which makes it even more urgent, which makes it more important for urgent recourse. So some changes, like all players should commit to timely revival process and strengthen the RP system, and also onboard the judges in case of pendency and vacancies in the tribunals. And lenders are also reluctant to participate as it involves in the CRP, as it involves the huge payments to IRPs and they see no light of the day, which is also concerning. So in my opinion, these should be there should be some capping of on the fees of the IRPs, lawyers, valuers and other professionals who participate in the entire process of CRP. And another thing, I feel that the professionals are not experienced enough when it comes to reviving the operations of the company or dealing with the operations of the company. Though they take the charge, but they fail to revive the company.
June 13th marked the completion of 5 years since the RBI identified 12 highly stressed debtors for insolvency resolution under the IBC. These 12 accounts were popularly referred to as the Dirty Dozen. They had an aggregate outstanding claim of 3.45 trillion rupees as against a liquidation value of 73,220 crore rupees. Out of these, the resolution plan has been approved for 8. 2 are still undergoing insolvency proceedings and liquidation has been ordered in the case of the other 2. The recovery ranged from 115% to 387% of the liquidation value for the 8 cases that were rescued through resolution plans. Bhushan Steel's resolution was done and dusted in under 300 days. SR Steels took a grueling 865 days because of litigation. Meanwhile, the lofty haircut taken by banks in several cases like Siva Industries and Videocon Industries came up for criticism by the lower courts. The Supreme Court made it clear that if lenders, in their commercial wisdom, think the offer is good for all stakeholders, then the NCLT and the NCLAT must not interfere. Courts have played a pivotal role in modeling the IBC and paved the way for evolving jurisprudence. As the insolvency law matures, one can expect the average time for a resolution to shorten. One should judge the success of IBC not just from the point of view of recovery percentage. There are other parameters to judge its success too. As a key economic reform, it shifted the balance of power from borrowers to creditors and instilled a significantly increased sense of credit discipline among debtors.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Markets too take a beating when a big company falls. Meanwhile, key benchmark indices cracked around 3% on Monday. The Indian rupee too recorded a new all-time low. Against the backdrop of yesterday's fall and overhang of global sentiment, our next report tells what lies ahead for the markets and what are the key support levels to watch out for.
With the retail inflation in the US coming in hotter than expected at 8.6%, market concerns have resurfaced that action from the Federal Reserve and other central banks could risk tipping the economy into recession. The fears resonated in the markets yesterday as equities crashed, emerging markets currencies hit fresh lows while bond yields rose the world over. Back home in India too, stock markets cracked heavily with the S&P BSE Sensex dropping 1,457 points to end below the 53,000 level. The Nifty 50 meanwhile tanked 427 points to give up the 15,800 level. The Nifty Bank Index also dropped over 1,000 points to settle near 33,400. Investors now fear that inflationary concerns have broadened in the US, going beyond the known drivers such as supply chain bottlenecks and energy shocks. In India, market participants are worried that the country's sticky retail inflation in May could turn the Reserve Bank of India even more hawkish. Going forward, experts see a hazy near-term trajectory.
So the Fed rate hike is digested and discounted by the market, and so is RBI hike that will come through in future. The problem is, the constant selling from the FIs and the global market correction. It's not only that our market is corrected, globally the markets have corrected. We could possibly see downtick in the market in the near term, but long term, I think these are great opportunities for investors to buy quality stock. Selective in certain sectors and all that. Short to medium term, there are a lot of concerns and overhang which we'll have to possibly face.
Technical charts too indicate around 2% downside potential in benchmarks as they hover around crucial support levels after Monday's mayhem.
A firm gap down session on Monday is triggering a negative bias one more time. For both the indices, 100 weekly moving average becomes the immediate support. For Sensex, it is 51,250, and for Nifty, it is around 15,300 levels. These are the key levels and the key average that could provide some ground, some stability for the benchmark indices. In terms of other significant index, if we look at Nifty Bank, it is trying to hover and linger and trying to find support around the same 100 weekly moving average, which is currently placed at 33,100 levels. In terms of the most battered index, which is the IT index, having had the formation of head and shoulder and a breakdown that violated 50 weekly moving average, and to a certain extent it did break 100 weekly moving average in recent time. But one good thing about the Nifty IT index is it soon regained and closed above 100 weekly moving average, and now it has come back to the same level. So for the Nifty IT index, it is going to be a 100 weekly moving average. If it manages to rebound again, we could see some stability. Otherwise, if it stays under 100 weekly moving average, we could easily see a fall of another 3 to 4% in Nifty IT index.
Against this backdrop, Tuesday's market session will be guided by global cues, trajectory of bond yields and rupee, crude oil prices, and India's retail and wholesale inflation data.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Not just the scorched earth and people living on it. A good monsoon also suits the economy and markets. Weather and economy are closely linked. In our next report, we will explain how nature still rules over us despite all the technological advances. The Reserve Bank of India had come out with a study in April 2020 on the effect of weather on the economy. The report explained how GDP growth is connected with temperature and humidity. The RBI report had also said that rainfall has a larger impact on the economy in comparison to the changes in temperature. As the country gets warmer or when more than expected rains are received, the manufacturing and the service sectors tend to decelerate. The RBI study came about 5 years after an overwhelming majority of countries had adopted the Paris Agreement in December 2015. The pact had called for pursuing efforts to limit global temperature rise to 1.5 degrees Celsius. Human-induced warming has already reached 1.1 degrees Celsius above pre-industrial levels. Each of the last 4 decades was hotter than any decade since 1850. Changing weather patterns and an increase in average global temperature are emerging as a key risk to the macroeconomic outlook of both advanced and emerging economies. India too has witnessed significant changes in climatic patterns. Last year's monsoon had managed to deliver statistically normal rain, even though its distribution over time and space was highly erratic. Short but intense downpours, interspersed with longish dry spells, have been the distinctive feature of that monsoon. India's growth and inflation outlook continue to be influenced by the amount of rainfall received from the southwest monsoon season between June and September and its distribution. The country receives around 75% of its annual rainfall during these 4 months, which is vital for the agricultural sector as 65% of the gross cropped area in India still remains unirrigated. Besides precipitation, temperature and its variability are other key indicators of changing climatic conditions. During the last 2 decades, the mean annual temperature in India has witnessed a significant rise. So far, as per the India Meteorological Department or IMD, 2016 has been the warmest year on record for India. While the gradually rising average temperature is a long-term feature of changing climatic conditions all over the world, extreme or volatile weather events like changing rainfall patterns, its skewed distribution, increasing frequency and intensity of floods, unseasonal rainfall, heat waves, and droughts pose serious macroeconomic risks. During the last 2 decades, floods followed by cyclones, unseasonal rainfall, and heat waves have been the major extreme weather events. India is also witnessing rising sea levels and melting of glaciers, which can be attributed to global warming. An earlier IPCC report had pointed out that if mercury were to increase by 1.5 degrees Celsius, hot temperature events would increase by 4.1 times in a decade. Heavy precipitation would increase by 1.5 times, and the likelihood of agricultural ecological droughts would double. An International Monetary Fund working paper released in 2018 found that increases in temperature have uneven macroeconomic effects, with adverse consequences concentrated in countries with hot climates such as most low-income countries. In these countries, a rise in temperature lowers per capita output in both the short and medium term through a wide array of channels like reduced agricultural output, suppressed productivity of workers exposed to heat, slower investment, and poorer health. In an unmitigated climate change scenario, and under very conservative assumptions, model simulations suggested the projected rise in temperature would imply a loss of around 9% of output for a representative low-income country by 2100. The negative impact can be seen in total trade as well. Increase in temperature causes the demand for electricity to increase as the requirement for air conditioners, coolers, and refrigerators tend to rise. Tractor sales are positively impacted by the rainfall received. Also, an increase in rainfall tends to accelerate automobile sales. Rainfall also affects the amount of available irrigated area, which in turn affects agricultural yield.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to a report, climate-related weather disasters dented the US economy by over $145 billion in 2021. It was about 50% more from last year. That is all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.